Well, here we go, Hims and Hers mega Q3 earnings. Let's go through them. I hope you're all doing well out there. I'm doing well, especially after seeing these earnings. What another excellent quarter from Hims and Hers. We're going to break down the earnings. We're going to talk about the good. We're going to talk about the bad, because there was a couple of bad points to this earnings report, so I'll talk about them. But overall, it was another fantastic quarter, a 10 out of 10 quarter. One of those that you look at this stock and you go, how is this below $10? It should be above $10. And getting onto the share price today, and fundamentally, obviously, the main thing we can ask is the company keeps smashing it, which it did do. That's all we can ask for, and eventually it will get reflected on the share price. But the share price point of view is that I did have a quick look on it when they brought their earnings out, and I was quite surprised to see there was initial shoot up, and then it was only up like 3% after these earnings, and I was actually looking at the earnings and just the share price after the earnings, went, how is it only up 3%? But obviously, as the day has gone on today, we've seen the share price start to reflect a lot better price for a company that's doing these numbers, which was absolutely amazing. So yeah, hope you enjoyed the video, and congratulations to any of you guys that are Hims and Hers shareholders. It's been a very good couple of weeks in the stock market, and just to top it off, these earnings from Hims and Hers has made another fantastic addition to what's been a couple of good weeks at the moment in the stock market. So let's go through these mega earnings from Hims and Hers as we normally do. Obviously, DraftKings and Hims and Hers are normally two earnings I'd normally break down in full on the YouTube channel. I'll say they're not as these earnings, in my opinion, weren't as good as DraftKings earnings, but they were still fantastic, like 10 out of 10 earnings. And once again, like I said, you're questioning why this stock is below $10. So anyway, let's go through the numbers. So EPS negative of 0.04, missed by 0.1, nothing major there. In fact, if you actually watch my earnings preview, I said the EPS guidance from analysts was way too high. I think last year they went from 0.9 and normally it falls by about half, so that would suggest negative 0.045. So 0.05 or 0.04 would have been the right estimates from analysts. I think analysts were just way too high there, but it was only a bit of a cent miss, so it's not that major at all, so we can let that go. The only little disappointing thing is you normally say it was a triple beat, and we can't say that because they did miss the EPS, but like I said, when it's that small, it's nothing major at all. Revenue 56.5%, which is very good, beat by 6.43 million. Another really big beat on the revenue guidance, which we have come to expect from Hims and Hers, so that was obviously really good. The big thing was the guidance. The guidance was very good, so I don't know why I put 2024 there. That should say 2023. It's because I'm starting to get used to writing 2024 down so much now, with us being towards the end of the year. Revenue to be 870 million versus 846 million expected. Obviously, that's very good. I wonder if this is going to be a little higher towards maybe 900 million by the end of the year. We'll see what happens. EBITDA to be 44 million. That's a 5% margin. This quarter, though, they were 67%. So even though it's 5%, it's actually, when you look at the recent numbers, it's getting higher and higher. The suggestion is potentially, do we see a 10% EBITDA margin next year? We'll see what happens. The big thing is that what we're seeing now is that EBITDA is 44 million. We're towards 6 and 7% margins, and that just keeps improving. The suggestion is that, obviously, from a revenue point of view, we were expecting Hims and Hers in 2025 to do 1.2 billion in revenue in 2025. Now, looking at this, they're probably going to hit it before 2025. So we'll see what happens there. But obviously, if they're starting to get towards a 10% EBITDA margin, you're looking at that going, by 2024, we could be talking about this company doing 100 million in EBITDA. Now, obviously, this company, I think, obviously not taking today's share price jumping, but it's a 1.3 billion market company. So we could actually see this company trading at around about 13 times EBITDA in 12 months' time. Now, 13 times EBITDA is already a pretty low valuation or a fair valuation, but when you consider that's for a company that is normally maybe growing at 7, 8, 9% maybe. But when you look at this company and it's coming off a 56% year growth, that's you shouldn't have a company that's doing that growth at that sort of low valuation. That once again comes to the point of view where this stock shouldn't be below $10. This stock right now should be above $10. And if we actually do start seeing them do 100 million in EBITDA, I think if you look at the point of view where I think when we get to the back end of 2024, nearly 12 months away now, we realistically go, this stock shouldn't be a $10 stock, it should be a $15 stock. This is how good the numbers are getting now. So obviously, really good numbers, especially on the revenue point of view, but the EBITDA ramp up this year has been impressive. Revenue per user was down 4%. That was something that I was a little bit like, could be a little bit better. Now we know they have taken on a lot of price changes to be a lot more competitive. So we can kind of put that down to the reason that was, but obviously we always want to see that keeping steady or improving. So that was only a little bit of a number that I would like to see get a little bit better, but there was explanation of why that was happening. Average order volume was up 19% though, so maybe that's because people once again are cross-selling or buying more, or maybe because the products are cheaper or they're expanding categories. To see the average order volume going up 19% was once again a positive. Wholesale was up 39%. Obviously that is good to see the wholesale part of the business increasing once again. Gross margins were 83% compared to 79%. Especially when you look at wholesale and the price cuts that they were taking, I were expecting gross margins to maybe come in a little bit weaker than this, so that was actually really impressive. The fact that they're holding an 83% gross margin is absolutely fantastic, and the way they're improving it as well is great. Net loss, obviously a few people point down that it's still net loss making. It did though go from 18 million down to 7.6 million, which is obviously still a very good improvement in the net loss department. The big thing though is they are EBITDA profitable though. So what that did mean is the cash balance did go from 46 million up to 57 million. So that balance sheet that is already fantastic with no debt on there, the cash is actually getting stronger on there, which is obviously really good. And obviously we're at a turning point now where they are starting to move into that profitability side of it, and we will see that cash go up more and more. So that strong balance sheet is only going to get stronger from now on, which is obviously fantastic. Now going into a few more things and a few things from the conference call. The thing that I was the least happy on in this conference, in these earnings in the conference call, was the stock-based compensation. I was not happy to see that increase 70%. Now they did say that was flat quarter to quarter, but that was as well because they did increase it a little bit in the last quarter. For me, the stock-based compensation, I was like, that's a little too high, and I was a little bit unhappy about that, and I hope management get a bit of a telling off about how much stock-based compensation they're taking. I understand stock-based compensation, it's a good way not to actually pay money, and you help your profit point of view, even if you are diluting shareholders. These positives around it, even though a lot of people do make it out to be a negative, especially since everything money turned up on the YouTube scene 2 years ago, they seem to point it out as a massive negative, and it's not always a negative. But I understand that the company is doing financially amazing, and at the end of the day, if you want the best people at your company, you've got to pay them, whether that be through actual cash or through stock. So I would want to reward the company because they are doing amazing. My only thing is that unfortunately there's a point of view where when the share price is here, you can't give yourself that much stock-based compensation. When it's a lot higher, fair enough, shareholders are getting the rewards, you can get the rewards, the stock's higher, less dilution, that's absolutely fine. So I would say that I wouldn't mind them having the increase as long as the share price was reflecting it. And at the moment, even though it shouldn't be this low, I think they should take a little bit more pain with the shareholders, and I think the stock-based compensation should maybe only be up maybe 30%-ish. I think 70% is way too much, and I wasn't happy about that. So that's something that I would want to see improve. Marketing was up 42 million. And the revenue did go up 82 million. So once again, one of the criticisms I've seen Hims and Hers have is that, the company is only growing this much because of the marketing spend. Well, the marketing spend was exactly the same to the revenue proportion that they've always done. And as well as that, the marketing spend only increased by 42 million. What revenue did it generate? It generated nearly double the revenue of the marketing. So the marketing isn't supporting the revenue growth. Obviously, it's increasing it, and they are taking advantage of having that money to be able to go get more market share, and that will pay them off in the longer term. And these are part of, the growth would not be this good if it wasn't for the 42 million marketing spend. But what they are doing is they're taking a good amount of time, they're taking market share, and they're getting more revenue in than the marketing spend they're increasing by. So there's no issue with the marketing in my opinion. 22 million in expenses increase, flat quarter over quarter. Now, once again, with the expense increases, I don't mind them investing into the company because they've got new categories coming in. You always want to see the company improving. So I don't mind them increasing the expenses. I would maybe like the expenses to be a little bit lower, maybe around 17 million, 18 million. So I would have liked the expenses to be a little bit lower than where they are. I think that went up a little bit high, but still I can understand it because they're expanding so much. There's new categories coming in like the weight loss. They have to have the platform to support it. So it it was okay. Maybe if we can just keep on top of it a little bit though. They did announce probably the biggest surprise of the whole earnings was the share buyback. I looked at it when it was announced that they were doing a share buyback and I went, whoa, I didn't expect that one on this quarter. So they announced a 50 million share buyback. Now obviously, when your stock-based compensation is quite high, obviously to offset your shareholders being diluted, doing a share buyback is a good way to counteract that. So I appreciate them that they go, okay, the stock-based compensation might be increased a little bit, but we're not going to dilute you as shareholders because we're going to use the cash now to buy back 50 million of shares over the next 2 years. Now, like we said, Hims and Hers is at a point now where they're starting to put adjusted EBITDA profitable up. The cash balance is going to start going up. So they're going to be at a point where they can afford to do this now. So this is good that they are protecting their shareholders from that point of view. They could go from a point of view of, oh, you know what, we're not going to buy shares, we're just going to do the stock-based compensation. I thought that was a really good move from Hims and Hers. So that was really good to see. Hopefully that can increase in as well over the next kind of couple of coming years. They said that mental health is growing 100% over triple digit. They said triple digit. I don't know what exactly it is. It could be even more than that, but they did say the mental health is one of the strongest categories at the moment. They said weight management is coming. Obviously, we've heard about this announcement. I think it was it the last quarter or the quarter before? They announced that we're going to enter the new category of weight management, which is a massive category to enter. They said that that's going to be launched in the next few weeks. So when we get to the Q4 earnings, we should get the first kind of signs of how the weight management is going, and then obviously over the next kind of 12 to 18 months, then we'll start to get a real big picture if this has been or is a good category expansion for the company itself. They said they announced MedMatch, their AI tool that they launched, that's more focused into the mental health category at the moment, and they will expand that, obviously using AI at the moment. And they left the biggest statement of the whole quarter, in my opinion, to the last statement of the conference call, which was first net income quarter is coming. We know it's going to be coming. Obviously, at the moment, it's analysts are forecasting that they can't make profitability, which is just shocking to me. Obviously, we've seen they've guided the revenue numbers totally wrong for this company in the last few years. Even in the next quarter, in next year, I think they're forecasting like 20-something% growth. Like it's at least going to be 30%. So once again, the way out of touch on the revenue growth. But on a profit point of view, they've always got the company wrong on a profit point of view. And once again, they're getting it wrong. We've seen EBITDA profitability start kicking in now. And obviously the losses are coming down. The big thing is when are they going to start making net income positive? And if you actually look at analysts, I don't think they're even forecasting them to do it in 2025, which is absolutely crazy. But they did say the first net income quarter is going to happen in H1 2024. So either in Q1 or Q2, we're going to see the company actually post a positive quarter, which will be absolutely amazing to see. And then I look at the company and you go, you've got really no negatives about it anymore. You know, the growth that it's got, you know, the now EBITDA profitability, the losses are coming down, and obviously, you know, we're going to be net income positive within 6 months' time. Now, what they also said after this was the really surprising thing, and I think realistically this is what's going to happen. They said that we could see net income positive in Q4 2023. So right now, Hims could actually be profitable. That's a game changer, because if they actually pull out that in Q4, imagine what they're going to do in 2024. We're going to be talking about potentially a company that is profitable, growing at these sort of levels, buying back shares, 8% gross margin company. That's crazy. That's crazy. That's a point of view where I go, this stock should be $10 right now. Probably by the end of the next year, we're going to be looking at this stock and going, it probably should be $15 right now. If we're at a point of view where they are doing all this and they now have net income as well, it's crazy. It's crazy. Like, you know, I think they're going to do it in Q4. Historically, when Hims have said something and they said, well, it might happen as soon as this, they do it as soon as this. So I think they were letting us a little bit of a secret there. So yeah, I mean, overall, you look at the numbers, obviously fantastic, really, really good quarter again, and you look at the valuation, it doesn't make sense for this company that's doing this sort of numbers. Very, very good quarter, 10 out of 10 quarter, and once again, I don't know what Wall Street's waiting for on this one, because the fundamentals have just improved rapidly, even quicker than what I can think. I thought they would do. Obviously, the only one really big negative I had on this quarter was the stock-based compensation. I thought that was a little bit too high of an increase. That's the only thing that did annoy me a little bit, but apart from that, obviously another really good 10 out of 10 quarter, and I think that sooner rather than later this is going to get a more fairer reflection, even with 15% jump today as we're recording this video. I think, sooner rather than later, we're going to see this above $10 stock again. I just don't know when it's going to be, because the fundamentals are there, and they keep improving. So, yeah, it's been obviously a really, really good year for this one, and hopefully when we get the next update in probably February time, hopefully they finish this quarter off very strong. And if we do see that net income as well, that's something that I didn't think we'd see for another 12 months yet. So that'd be a really nice positive if we see that to finish off the year with. Anyway, so yeah, if you are a Hims and Hers shareholder, I would say well done. I think you've done well, especially as we've seen this one dropping once again into the $6 range. It was absolutely crazy. I think we've got a really strong company here that's firing on all cylinders and beating expectations massive. So yeah, good quarter once again. Thanks for watching. If you found the video helpful, subscribe, and I'll see you in a bit.